Welcome back to Talk Tickers. Today, we are opening up the hood on a company that I think a lot of people still have filed away in the wrong mental drawer. We're talking about Baker Hughes.
BKR.
And if you've been watching the tape today, you've seen the reaction. The stock is reacting positively, up nearly 4%, trading firmly around that $56 handle.
Right.
But here's the thing that makes this so fascinating. If you just glanced at the headline revenue number, you might be scratching your head asking why.
It's the classic head scratcher because on the surface, revenue was essentially flat. And, usually flat revenue doesn't get you a pop like that.
Not at all.
So the mission today is to figure out why the market is suddenly treating this differently. Is this still an oil services story, or are we looking at something else entirely?
Exactly. It feels like a total vibe shift. It was a beat and raise style energy on the call, even if the top line didn't, explode upwards. So let's unpack this. We're looking at the Q4 2025 earnings and the outlook for 2026. What's the big picture thesis here?
The big picture is what management calls Horizon 2. I mean, we are moving past the cleanup phase and into a phase of distinct multiple expansion. The thesis is simple. Baker Hughes shouldn't be trading at an oil services multiple.
Like a Halliburton or a Schlumberger.
Exactly. They are arguing that they should be trading at an industrial multiple like an Eaton or a GE Vernova. And looking at this quarter, that argument is getting a lot stronger.
So the market is finally waking up to this industrial pivot.
It really is. We are seeing a company successfully rebrand itself from, a cyclical driller helper to a secular growth engine for the AI and data center power boom.
That is a massive claim. From oil driller to AI power engine. It sounds great in the slide deck, but the numbers have to back that up. So let's start with the results snapshot. Give us the headline numbers that's got the street excited.
So the beat was squarely on the bottom line. Adjusted EPS earnings per share came in at 78 cents for Q4. The consensus was only 67 cents.
That is a massive beat. 11 cents.
11 cents. In a mature industry, beating by double digits on EPS is a serious signal of efficiency.
That is significant. And what about revenue?
Revenue came in at $7.39 billion. That is, like we said, essentially flat year over year. But here's the kicker. It still beat the street's expectation of $7.07 billion.
So they cleared a low bar, but they cleared it easily.
Right. But the real star, the number that actually matters for this industrial thesis, was the margin expansion. Adjusted EBITDA hit $1.34 billion, up 2% year over year. But margins, they expanded to a record 18.1%.
Operational leverage. That's what investors want to see. Even if you aren't selling significantly more stuff, you are making significantly more money on the stuff you are selling.
Exactly. And that flows right down to the cash. Free cash flow for the quarter was a massive $1.34 billion.
Wow.
For the full year, FCF hit a record $2.7 billion. Their conversion rate was 57%, which is well above their own target of 45 to 50%.
That conversion rate is what industrial investors drool over. It's consistent, it's high quality.
Precisely. The tape loves the margin expansion and the backlog growth despite the revenue flatness. The quality of the earnings is just higher now. It's becoming predictable. And predictability commands a premium.
Okay, let's go deeper. Because to understand this company right now, you really have to look at it as a tale of two segments. You have the old world oil field services, and the new world industrial and energy tech, or IET. It feels like they're living in two different economic realities.
They really are, and you have to sum the parts to get the valuation right. Let's start with the growth engine, IET. This is where the re-rating lives. Revenue is up 10% year over year to $3.8 billion.
Okay, strong growth.
But again, look at the margins. IET margins hit 20%, of 160 basis points.
20% margins. That's the psychological barrier, isn't it? That's that industrialized profile they've been promising for years.
It is. When you cross 20% EBITDA margins, you stop looking like a commodity service provider and start looking like a specialized technology manufacturer. And the orders back that up.
Okay.
They booked $4 billion in orders just in the quarter. That brings them to a record annual order intake of $14.9 billion.
That is huge.
And if you look at their RPO remaining performance obligations, which is basically their secured future revenue, it's at a record $32.4 billion for IET. That is a massive visibility moat.
That means even if the economy takes a nosedive tomorrow, they have work to do for years.
Correct. And what I found really interesting is the mix inside those orders. It's not just big LNG terminals anymore.
Right, because for a long time, people thought of this segment as just The LNG turbine guys.
Yeah.
Waiting for a big gas export terminal to get approved in Qatar or Louisiana.
Yeah.
Is that still the case?
No, and that's a critical nuance. The expert analysis on this is that the mix shift is working. Non-LNG orders are now 85% of the total IET book.
85%.
85%. This proves diversity. They're winning in power, in new energy, in industrial tech. They aren't just waiting for the next big gas export terminal to get greenlit. They've diversified the portfolio significantly.
So IET is flying. But then we have the cash cow, the oilfield services and equipment, or Audi SE. This looked a little shakier on the top line.
It did. Revenue actually fell 8% to $3.6 billion. If you're just an oil services investor, that looks ugly.
Usually when revenue drops that much, operational leverage kicks you in the teeth and margins collapse. Did that happen here?
No, and here's where the resilience narrative comes in. Despite revenue dropping nearly double digits, margins stayed resilient at roughly 18%. That is impressive cost control.
How are they doing that? Is it just firing people or something more?
It's structural. Management is aggressively cutting costs and simplifying the structure. They're removing duplication between regions. Geographically, North America is still soft. They're expecting a mid-single-digit decline there in 26 due to capital discipline from drillers. But the international and offshore markets remain the floor. The Middle East and deepwater activity is keeping the baseline strong.
So investors are forgiving the top line drop here because the margins didn't fall off a cliff.
Right. It's proving the reduced cyclicality thesis. If they can hold margins flat while revenue dips, it proves they aren't just at the mercy of the oil price anymore. They can control their own destiny through efficiency.
Okay, now let's get to the part that I think is really driving the stock today. The alpha, the AI and power play. The CEO, Lorenzo Simonelli, is calling this a global power demand decade. That is a big claim.
It's a huge claim backed by big numbers. We are talking about data center power demand projected to grow at a 12% CAGR through 2040.
12%. Compounding for 15 years is enormous.
It's massive. But we hear about power demand all the time. What is the specific angle for Baker Hughes?
Right. What's their bottleneck?
Yeah. The angle is the bottleneck. You need reliable, dispatchable power. You cannot run a hyperscale data center, which is basically a giant building full of hot, expensive chips on intermittent wind and solar alone.
Because if the wind stops blowing or the sun sets, you can't just tell the AI to take a nap.
Exactly. You need backup, and increasingly you need primary generation on-site because the grid itself is too congested to even connect you.
And that's where Baker comes in. They booked $1 billion in data center related orders in 2025, and they just upgraded their guidance.
They did. They are now expecting $3 billion in data center orders between 2025 and 2027. But honestly, the dollar figure isn't even the most interesting part. The real story, the specific detail that should grab your attention is the Nova LT story.
The Nova LT. Explain this to me. This is their hardware.
This is their industrial gas turbine. You can think of it as the iPhone of this specific industrial cycle. It's modular, it's efficient, it's exactly what these data centers need for on-site power. And here is the critical detail. They are effectively sold out through 2028 for Nova LT slots.
Wait, sold out for 3 years?
3 years. If you call them up today and want a turbine, you are basically waiting until 2029. They are doubling their manufacturing capacity by the first half of 2027, but demand is still outstripping supply.
That is wild. I saw something in the notes about a slot reservation. That sounded unusual for this industry. What is that?
This is fascinating. They secured a slot reservation agreement, which is a paid option, essentially putting hard money down just to hold a spot in the manufacturing line for 1 gigawatt of capacity for a data center client.
1 gigawatt. That's not a data center. That's a small city.
It's massive. And think about the psychology of that. Clients are paying just to reserve the right to buy the equipment later. That speaks to absolute desperation in the market for power generation.
They're terrified they won't have the electricity.
The hyperscalers have the chips, they have the buildings, but they're scared they won't have the power. It's the ultimate picks and shovels play for the AI build-out.
It absolutely is.
And it's not just the turbines. They also won a deal for 40 brush generators. That's 7 GW total for utility scale power. This is for grid firming. So whether it's behind the meter at the data center or bolstering the grid itself, Baker is selling the hardware that makes AI physically possible.
So if we connect this to the bigger picture,
Yeah.
this is the re-rating catalyst. They are integral to the tech stack now, not just the energy stack.
Correct. You can't run a data center on hopes and dreams. You need turbines. And right now, Baker Hughes is one of the very few companies on Earth that can make them at scale.
Let's move to the future. Horizon 2 and the 2026 guidance. What are they telling us to expect?
The strategy for Horizon 2, which covers 2026 to 2028, is to be a boring, predictable industrial company. And I mean boring in a good way.
The best way.
For 2026, they are guiding for revenue around $27.25 billion. That's steady. Adjusted EBITDA around $4.85 billion, which implies mid-single-digit growth.
Mid-single-digit growth doesn't sound explosive.
It isn't. But remember, the goal is durability. They are sticking to that 20% margin target for IET, and they expect free cash flow conversion to stay around 50%. They are telling the market, we aren't a boom and bust oil stock anymore. We are a compounder.
They're also cleaning up the portfolio. The Chart Industries acquisition is closing in Q2. Why does that specific deal matter?
Chart adds thermal management. If you think about data centers and LNG, cooling is just as important as power. It's a crucial adjacency. They also divested the PSI business and deconsolidated the SPC joint venture. It's all about streamlining.
Getting rid of the noise.
Getting rid of the noise so the high-quality industrial earnings shine through.
And what about the oil call? Did they give us any hint on when the drilling market comes back? Because eventually the world does need more oil.
Management was cautious. They see 2027 as the potential start of the next upstream upcycle. They basically flagged 2026 as a transition year for oil. North America is in capital discipline mode, preserving inventory, but international and offshore is where the growth will be long-term.
And there was a subtle nod to the board reviewing options, right? Activist pressure.
Implicitly, yes. They mentioned this strategic evaluation regarding unlocking value that usually translates to, we're looking at spinning off or separating businesses if the stock price doesn't reflect the sum of the parts.
Right. It keeps a floor under the stock.
It does, because investors know management is actively trying to close that valuation gap. If the market doesn't give them the industrial multiple, they might just spin off the industrial business to force the market to value it correctly.
So let's wrap this into the so what for the investor listening right now. What is the fundamental case?
The logic is valuation arbitrage. If they execute on Horizon 2, if they hit those 20% margins in IET and deliver that cash flow, the stock shouldn't trade like Schlumberger. It should trade like GE Vernova or Eaton. It's a multiple expansion play.
But there are risks. We have to be realistic.
Always. Execution is number one. They have to deliver those margins. They can't slip up. Secondly, supply chain. We just said they are sold out of turbines. That's great for pricing, but can they actually build them fast enough?
A good problem to have, but still a problem.
It is. If they have a shortage of parts, that revenue gets pushed to the right and the growth story stalls.
And tariffs.
Tariffs are a real concern. Management explicitly flagged tariff costs as a headwind for 2026 margins. We know the geopolitical environment is shifting. If it becomes more expensive to move steel across borders, that eats into that beautiful 20% margin.
But the signal seems to be that the backlog, that $35.9 billion total RPO, protects the downside.
It does. Even if the economy slows, they have work for years. That's the industrial safety net.
All right, this is the part of the show where we like to step back from the spreadsheet and get a little creative. We've looked at the data, we've heard the call, now let's talk strategy.
Disclaimer time. This is absolutely not financial advice. We are just two voices on a deep dive. Do your own diligence. Do not trade based on what we say.
Understood. But if we were pitching a trade idea to a hedge fund investment committee right now, based strictly on this earnings print, what is the play?
I'm calling this the turbine squeeze arb.
The turbine squeeze. I like the sound of that. Break it down.
The premise is what we just discussed. The Nova LT turbines are sold out until 2028. This is a hard supply constraint and the hottest sector on Earth AI and data centers.
Okay.
So the trade is, you go long Baker Hughes, the owner of the scarce asset manufacturing, and you short a generic AI hyperscaler or a data center REIT that has announced massive CapEx plans but hasn't secured power yet.
Ooh, that is spicy. You're betting against the guys who forgot to buy the batteries, essentially.
The logic is simple. The hyperscalers have infinite CapEx budgets, but they have finite power access. The bottleneck gets paid the premium. Baker Hughes holds the golden ticket for on-site power generation.
So if you don't have a Nova LT slot reserved, your data center is just a really expensive fancy warehouse.
Exactly. Or if you want a more traditional sector pair, you go long Baker Hughes and short a pure play North American land driller.
Because the driller is facing that decline in 2026.
Right. You bet on the industrial multiple expansion for Baker while fading the cyclical decline in U.S. land drilling that management just warned us about. You're swapping old energy for new energy.
Both of those sound like they have some serious logic behind them. It's all about positioning for scarcity.
It is. In a world of abundance, the bottleneck is king. And right now, the bottleneck is power generation hardware.
So to recap, Baker Hughes delivers the beat. Margins are up to record levels. The industrial pivot is not just a slide in a deck, it's showing up in the P&L with that 20% margin handle.
And the most important number today wasn't the EPS, it was the fact that they are sold out of turbines for 3 years. That tells you everything you need to know about where the demand is going.
Absolutely. The market is efficient, but sometimes it takes a quarter like this to really wake everyone up to the new reality. Baker isn't just drilling for oil anymore, they're powering the cloud.
A fascinating transition to watch.
That is going to do it for this deep dive into Baker Hughes. As always, thanks for listening to Talk Tickers. This is for entertainment purposes only, so please do your own homework.
We'll see you on the next sprint.
See you then.